Fun fact, the first ever mutual fund was created back in 1774 by a Dutch merchant. He was looking to pool money together and protect smaller investors from large company risks by spreading exposure over a number of different companies. You smell that? That smells like diversification to me. Hey, what's up guys? Thanks for tuning back in. And if you're new, make sure you hit that subscribe button so that way you can check out weekly posts on personal wealth management and market insights. My name is Ash, certified financial planner, bringing you the knowledge, perspective, and resources from my world to help you live a better financial life. Today, we are touching on a hot topic that is always a question for many investors. What the fuck is the difference between ETFs and mutual funds? So I'm going to break down the conversation into what are ETFs and mutual funds, then explain the differences for you. To start things off, both ETFs and mutual funds are investment solutions created by large asset management companies to allow investors to invest in different areas of the market. And these are great solutions because what they do is they help you diversify your exposure when you invest. And you probably heard of the overused term of don't put all your eggs in one basket. Yeah, that's not what we meant. I'm talking about your investment selection. So with ETFs and mutual funds, instead of you doing the research, analysis, and stock picking yourself, these professional money managers created mutual funds and ETFs to do that for you. So in a nutshell, these ETFs and mutual funds are a collection of stocks that these asset managers choose to invest in, and in turn, they allow you to buy shares of that mutual fund or ETF. So when the stocks of the companies that they chose in those funds go up or down, the mutual fund or ETF you bought does exactly the same. So with mutual funds and ETFs, your exposure is diversified across a number of different companies. Let's break down the differences between ETFs and mutual funds. Here we go. Let's start with mutual funds. I mentioned earlier that mutual funds are created and actively managed by a team of money managers. I'm going to put a smiley face on him because when it comes to the fee component, mutual fund managers can charge upwards of 1%. And the reason why they are charging 1% is because they are creating a portfolio of companies and selecting them based on their research and their analysis. So they'll have company A, company B, company C, and etc. Some mutual funds can have hundreds of companies to diversify risk. And basically what they do is they monitor, track, and analyze the performance of these underlying companies. And periodically, whether it's quarterly, annually, or pretty much whenever they feel, they can rotate how much they have invested in either company. For example, let's say that company A's performance sucked in 2020. So they decided to get rid of some shares, and company B sucked even worse, but they decided to buy more because they are optimistic on the stock. And for company C, they're neutral, so they didn't add or subtract. What this equates to is called active management. This is the reason why mutual funds charge 1% plus in many cases, and is because the amount of research, analytics, and manpower required is extensive. Lastly, when it comes to mutual funds, they trade intraday, which basically means they do not trade during normal trading hours of the stock market. So when you buy or sell your mutual funds, the trades are being processed at the end of market close. So that means the value of the underlying companies are as of market close that day. So basically, if the markets are tanking and you have a mutual fund and you panic sell everything, your order won't be processed until the end of business day. But no one should ever panic sell. So if someone you know does, they haven't watched my videos yet, so be sure to share my page with them. Next, let's transition over to ETFs. ETFs stand for Exchange Traded Funds. Think of ETFs as the younger brother of mutual funds. They have the same objectives as mutual funds to diversify your exposure across the market with some key differences. Remember how mutual funds had a money manager team that actively manages the fund? Well, for ETFs, they don't have a team that actively manages it. So in turn, that means the fees on ETFs are low as fuck. Some of the lowest I've ever seen are 0.05%, and some companies even started coming out with 0% ETF fees. So since they are not actively managing, the portfolios are not being rotated. So whatever companies are in that ETF, they stay pretty much locked in. This is a form of passive investing. ETFs can track sectors, aka industries like healthcare, financials, technology, different asset classes like commodities, precious metals, or bonds. And lastly, a really important component is indexes. So if you've heard the term index fund, it's basically an ETF. And there are a number of indexes out there like the S&P 500, NASDAQ, Dow Jones, Russell 2000, etc. Lastly, ETFs trade intraday, which means that you can trade them during the day, just like a normal stock. So let's take a look at some key differences between ETFs and mutual funds. The most important is going to be the active versus passive. This is driven by the fact that one has a money management team that does extensive research and monitors and tracks and rebalances, and the other doesn't. This in turn results in higher fees for mutual funds and much lower fees for ETFs. Lastly, they both trade a little differently, with ETFs trading during normal trading hours like a stock, and mutual fund transactions are completed at the end of market close. So the question burdens, which one is better? Well, when it comes to anything finance, it ultimately depends. I will say this though, passive investing has become extremely popular in the past 10 years as more and more investors are becoming fee conscious, and it's also really difficult to beat an index fund's performance that's performing on average 15% a year that costs literally nothing. So the conundrum is, which active manager is returning on average 10 to 15% year over year after taking their 1 to 2% cut in fees? Not to shame active management, but that is one of the downsides. On the flip side though, passive investments are all fun and games until the markets take a kind of like it did back in March and fell over 30%. In a perfect world, passive investments are ideal in a bull market where the stock market is going up and up and up. But when there is excessive volatility and large swings like we've seen this year, active management shines in that arena because you have that component of professional management, monitoring, and rebalancing. In my opinion, while most investors will say no to mutual funds because they think they're dog, I like the combination of both. Depending on your assets, age, and risk profile, I think both can complement an investment plan beautifully. So that about wraps it up on ETFs and mutual funds. Hopefully this overview gave you some perspective on the differences. Be sure to give this video a thumbs up and be sure to hit the subscribe button to support the channel. My name is Ash. I'll catch you guys next time.